This video is going to introduce you to corporations. In business news, what are some corporations that you've heard talked about? Maybe you've heard Apple or Google. You may hear the stock prices being discussed. So when you hear about these things, you're talking about publicly traded corporations. We are going to be talking about corporations that are publicly traded and that sell their stock. Stock is ownership of a business. If a corporation wanted to expand and needed additional capital, they can go out and issue stock. In exchange for giving up ownership to their shareholders, they receive money from these shareholders. Alright, so let's look at some of the changes that used to describe some of the words in here. So for the statement of owner's equity in a proprietorship. So in a proprietorship, we had, remember, the statement of owner's equity. And we have beginning capital, you may remember this, plus your owner's investments, plus net income, less your owner's withdrawals to get your ending capital. So now that we are a corporation, we're going to have a statement of stockholders' equity. No longer owner's equity, but stockholders' equity. Now this is the same thing as owners, but we call these owners in a corporation stockholders. So the statement of stockholders' equity can be broken down into two sections. We're going to have the paid-in capital section and the retained earnings section. So in the paid-in capital section, this is going to include all the money that came to us from our investors. Okay, for the paid-in capital section, and now in the owner's equity statement, that would be your owner's investments. But as you notice over here, we have several accounts. We have common stock, preferred stock, paid-in capital in excess of par, and paid-in capital from treasury stock. So these are all the accounts that came from our investors. And then the second section is retained earnings. These are going to be all the earnings that we have retained in our business. So it's going to be all of our earnings less what we've given out. So our dividends are what we have given out to our shareholders. Dividends are comparable to owner's withdrawals. The difference is the company has to declare and decide to give dividends to the owners. Whereas here the owner was the business and could withdraw money whenever they choose. And we'll talk about treasury stock later on in the chapter, and then that gets us to our stockholders' equity. So stockholders' equity is made up of paid-in capital and retained earnings. The reason the stockholders' equity is broken down into two sections is to let our users know how much money came from within the business and how much came from our investors. It's important for users to know where our money is coming from and whether our business is being profitable enough, or are we having to go issue stock and get money from our investors, which one is giving us the more money. So it's important to know where our money is coming from. Outside investors, or is it profitable from our profits within the company? Let's talk about some more terms. Par. Par is an arbitrary amount assigned to a share of stock. Let's say that for common stock you have 100,000 shares authorized, 10,000 shares issued, and $2 par. Let me tell you what this means. In our corporate charter, we have authorized 100,000 shares of common stock that we can issue. So far, we have only issued 10,000 shares to the public, so that is what is out there being publicly traded. So this $2 par value is the value attached to the stock when we issue it. Now, once it's out in the marketplace, the price of the stock changes every second. So as it's being publicly traded, the price of the stock will be determined by supply and demand. Now, in accounting, this par value is very important because we will use this in our journal entry, and you will understand why this is used and how this is used. In the next few videos, we will discuss how to account for stock and how to issue dividends. Let me know if you have any questions.